fear in the back of my throat. You know, most people, they try to move away from fear, try to organize it out of their lives as soon as they're able. Me, I cultivate it. I try to recognize it and order it and use it.
Let's talk about finance and business lessons from the 8th episode of Billion Season 2, based on my work experience at Goldman Sachs in New York City, and based on my work experience at the top hedge funds in the world. Now, please like, comment, and subscribe, and stick around, because at the end of this video, I'm going to grade the episode for Wall Street Realism with a buy, hold, or sell rating. Now, in this video, we're going to talk about 3 topics. The first topic is when is the best time to buy stocks and why we need to think like Warren Buffett and be greedy when others are fearful and fearful when others are greedy. Follow my humble advice in this video, and I promise you that your net worth will be materially higher in the long run. In topic 2 of 3, we'll discuss what is a prime broker and why are they crucial service providers for the top hedge funds. And then in topic 3 of 3, we'll talk about what is the corporate culture at many hedge funds and any company in general, and why this is crucial to understand before you join any company and how you can create an incredible corporate culture from scratch. Topic 1, when is the best time to buy stocks? Now, before I tell you when to buy individual stocks, let's first discuss the one indicator that will tell you when to buy almost all risky stocks and make you a fortune. And I'm putting my reputation on the line with this one. So let's go together to finance.yahoo.com and let's type VIX, V-I-X, and let's look at the chart, as every chart tells a story. Now, the VIX is a measure of volatility. And when the VIX is high, it means there's high volatility, meaning high fear. And stocks often go down when volatility and the VIX is rising a lot. Now, when the VIX rises above 70, like it did in the fall of 2008 and in early 2020, you need to go all in and buy more risky stocks and more risky ETFs. And I promise you that when it happens again, and it will, you're going to tell yourself that you're crazy to buy stocks now. But that is precisely why you need to buy, because everybody else is panicking. And remember, Warren Buffett once said that the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. So what can cause the VIX to spike above 70 or above 80? Well, it's often a rare event that we can't forecast, like a black swan, as Taleb calls it, kind of like COVID or some other terrifying development. Will it happen again? Absolutely. And whatever black swan event causes the VIX to spike this high will be terrifying. But we have to buy in size when it happens. Now, the VIX was created by the CBOE in 1990, and it measures the expected volatility on the S&P 500. And we saw a spike here because of Gulf War I, then here in the fall of 1998 because of fears about a potential Russian debt default, and because of the terrifying collapse, also at this point, of the massive hedge fund called Long-Term Capital Management. You can read more about this by reading this book here called When Genius Failed. Now, I remember this well. I worked then at Goldman Sachs on the trading floor, and Alan Greenspan unexpectedly cut rates right here. And all the traders on the trading floor exploded and started yelling on the phones because many hedge funds and mutual funds were calling to buy stocks. Now, why do they call Goldman Sachs trading floor? Because Goldman is their prime broker, which I will discuss in topic 2 of 3 of this video at this time code right here. Then after that, we see here we had a spike at 9/11. And then the VIX spiked here because of corporate bankruptcies and the dot-com bubble burst fallout, and also Gulf War II right here. And then the VIX spiked to above 70, as you can see right here, because of the financial crisis in 2008, when we were within 24 hours of bank machines not working. And then you can't see it right here, but in early 2020, during the COVID crisis, the VIX spiked to an all-time high intraday above 80. There was so much panic then that the futures price of oil went massively negative then. Yes, there was that much panic, and that is exactly when you buy, no matter what happens. And you need to always stay really unemotional and buy in size, which Elon Musk did, as we can see right here by this filing. Now, from a psychology perspective, buying when there's massive fear works really well, because if you think about it, If everybody loves a stock and everybody owns it, then there's not that many incremental investors to push it higher. But we have to think like Wayne Gretzky. This could be the most Canadian vlog ever. I am Canadian. We have to think like Wayne Gretzky, because when we buy stocks, we need to buy stocks that people are going to like. And Gretzky was very successful because he skates where the puck is going to be. So we have to buy stocks that people are going to like and think long-term as well. And successful investors and business people are contrarians. And so be a contrarian and stay unemotional and watch your net worth take off. Okay, we're done discussing the VIX for now. What about when to buy individual stocks after you've done your fundamental research? First of all, be very careful with FOMO, F-O-M-O, meaning fear of missing out. Fear of missing out, that's how we say it in Canada. Most of the time, you can always tell yourself this: I'm going to be patient because I can most likely buy this stock at a cheaper price. Just be patient. And as Bobby mentions in this episode, learn how to embrace your fear when investing.
Fear in the back of my throat. You know, most people, they try to move away from fear. That's how I survived growing up, and it's how I still live my life today. Heeding and listening to my fear.
Now, I love to buy broken stocks, but not broken companies. What does that mean? Well, what that means is when the chart is broken and the RSI is 20 or 30, and if I believe that the fundamentals are good in the long run, then I buy. But you have to be careful, because you don't want to get seduced into buying stocks just because they're cheap. Do the research, and in my Silver MBA program, I include this template here to help you analyze the fundamentals and valuation of companies. See the description link of this video for more details. But when you buy a broken stock, meaning one that looks like you're catching a falling knife, as part of your research, you got to ask yourself this: will this company and the sector it's in be more relevant or less relevant in years from now? And that will keep you logical and really unemotional when investing. You got to be contrarian. And for more details on technical analysis like the RSI, please see my video on Billion Season 2, Episode 2. The link is in the description as well. Now, another great way to think about when to buy a stock that you love as a long-term investment is if the stock does not go down on multiple negative news releases, then it might have likely found a floor, as likely all the short-term tourist owners of the stock have sold their positions. Conversely, if a stock does not go up on multiple positive events like good earnings, then the stock might be crowded and over-owned. And when I used to short stocks, I love shorting stocks that would not go up on several positive news events. And for a detailed explanation on shorting stocks, please see my Billions vlog on short selling explained, meaning season 1, episode 4 of Billions. The link is in the description. Lastly, please don't buy a stock because you see 10 or 15% upside in the next year, because stocks can go up or down that amount in the short run for random reasons, per Taleb's book here called Fooled by Randomness. Instead, do your own long-term research using my frameworks and invest in 5x5s, meaning stocks that based on your research can go up 500% in 5 years. Even if you're wrong and the stock only goes up 200 or 300%, then you're still generating alpha, meaning beating the markets. The bottom line on when to buy stocks is just be a contrarian and embrace fear as your friend and be a contrarian. Topic 2 of 3. What is a prime broker and why is this important for hedge funds?
We're not switching primes. Hold on. What? He's trying to get us to switch brokers. Wants to wine and dine us. Me.
Tell him we accept.
Not accurate, because large hedge funds often have multiple prime brokers. Now, what is a prime broker? It's like an old school stockbroker that you call that helps you buy and short stocks. Well, why can't you just use an automated order entry system to buy or short stocks if you're a large hedge fund? Because prime brokers can help you find shares to short that are not inside of automated trading systems. How? Well, hedge funds and mutual funds are called the buy side because they buy stocks. And when you see a trading floor on television that is not the stock exchange, that is the sell side, like Goldman Sachs, for example, or the fictitious firm called Spartan Ives in Billions. Now, the buy-side trader, Mafi, is talking to a sell-side employee called a sales trader that sits on the trading floor. And the sell-side sales trader has great relationships with large mutual funds and hedge funds, meaning the buy-side firms. And if the buy-side firm, Axe Capital, wants to short a lot of shares in a company, then the sell-side sales trader that is on the phone with Mafi can help Axe Capital find the shares to borrow so Axe can short them. How does the sell-side sales trader do this? Well, what they do is they call their buy-side clients, meaning other hedge funds and mutual funds, and they say this: I have a client that wants to borrow your shares so they can short them. If you don't plan on selling those shares that you own, then my client will pay you, for example, 5% per year to borrow your shares. And what I'll do is I'll give you 4% and I will keep 1% as I facilitated this share. Now, that explains the economics. And of course, a sell-side trader on the phone would not say, I'll keep the 1%, but you get the idea. Now, what other value does a sell-side prime brokerage firm like Spartan Ives or Goldman Sachs provide? Well, they also let you use leverage. For example, if Axe Capital is a $10 billion hedge fund, they can borrow money from the prime broker to invest much more than $10 billion. And this is like investing using margin. And up until 2008, many hedge funds used 10x leverage, meaning for every $1 in assets under management they had, they invested $10. And these hedge funds often ran what's called market neutral, meaning they're likely not going to be more or less than 10% long or short the market. And they can do that. They can use a lot of leverage if they have roughly an equal amount of longs and shorts in a portfolio. However, this leverage actually almost destroyed the entire market, and a lot of hedge funds went belly up in the fall of 2008. And I remember back then Warren Buffett saying that derivatives are financial weapons of mass destruction. Now today, partially because of government restrictions, prime brokerage firms are much more careful with providing hedge funds with too much margin, meaning too much leverage. And I worked on the sell side at Goldman Sachs and on the buy side at hedge funds. And when I worked on the buy side, I would have my trader, like Mafi here, check with our prime brokers to find out if I can short shares in a company at a very low cost to borrow. Then my trader on the buy side would call our prime brokers and other sell side firms and say, what is the cost to borrow in this particular stock? Now, if the cost to borrow was too high, like 10% or higher per year, then we might not short that company. And the prime brokerage firm also takes care of the custodial stuff, meaning they help to record which stocks I own, etc., and settlement issues. And prime brokers will also say that they can help you raising money with capital introduction. That's usually not the case, though. They're not that good at that. Now, when you run a business in general, you don't want to only buy stuff from one firm, as they won't give you the best deals. You want to have multiple companies sell you stuff, as competition is good for us, meaning the consumer. And as a result, top hedge funds often have multiple prime brokerage firms that they deal with. And I would always have multiple prime brokers so they can charge me the lowest commission possible. And this is why in this episode, Wags and Mafi agree to get wined and dined by another sell-side prime brokerage firm.
Yeah, you know what? Let's hear the pitch. Tonight at 8?
Sell-side firms compete aggressively with other sell-side firms to add as much value as possible to the buy side.
I thought we're loyal to Spartan Ives.
We're loyal to the bottom line. If there's money to be made by switching.
Plus a night of hardcore partying in the name of business.
So when it comes to wining and dining, hedge funds are much more careful now with compliance. The Wolf of Wall Street partying mentality doesn't really happen as often anymore. And many firms have limits on how much they can spend per client wining and dining. And to get around this, and this is not ethical, so please don't do this, but some sell-side employees might use their own cash to wine and dine so they don't have to use their corporate credit cards. Now, we can see in this next conversation with Axe Capital's current prime brokerage firm, Spartan Ives, that Wags only met with a competing prime broker because of this.
You didn't throw those Patriot Bank twinks in my face to tell me we're over. You did it to spice up the relationship.
What do you give me to stay home?
Accurate. And this ultimately worked out very well for Axe Capital.
Wags, what are you doing here?
Spartan Ives is reducing their fee 20% for the next 2 years.
Outstanding.
Topic 3 of 3. Corporate culture at hedge funds or any company.
The culture is set from the top. Since Axe likes me, other people do. Or pretend to.
Accurate. The corporate culture at many companies is often based on the personality of the CEO or the founder. Now, if the founder is an extreme type A personality, and if that rubs you the wrong way as it does with me, then be careful, because founders tend to hire people that have a similar demeanor. And you can judge this based on your interactions with others at the firm when you're interviewing or planning to work at that company. And a lot of hedge funds have really, really tough corporate cultures, as some hedge fund employees are not team players, because the only thing that matters is how much money you make the firm, as they are all meritocracies, meaning you eat what you kill. Plus, turnover at hedge funds can be really high, like 40% at firms like Bridgewater. And quite often you live in fear at hedge funds, as people get let go all the time. Also, at Bridgewater, all conversations are recorded except when you're literally in the bathroom. So how do you create a corporate culture from scratch if you don't want it to be based just on the founder's personality? Well, when I worked at Goldman Sachs, they had what are called the 14 business principles, and I'll leave a link to this in the description of this video. The first principle starts with our clients always come first, and I love that. And I recommend coming up with business principles like this for your company. Then when you interview anyone, you ensure that they fit the mold of the principles that you document. One more thing. Goldman Sachs does not hire the smartest people because they hired me. But to get a job there, you go through many, many more interviews than with other financial services firms. And I humbly think this is genius, because you can assess if somebody is going to be a good cultural fit or not. Meaning, will they be a team player and not somebody with a difficult personality? Because we all know that one difficult person can destroy the productivity and morale of the entire team. So please take your time hiring. Hire very slowly and fire quickly. And it's hard for me to fire quickly, but if you hire very slowly, then you won't have to make as many hard decisions, meaning letting people go. And if you've documented the corporate principles of your firm, then it will really help you in hiring the right people that don't suppress ideas and don't bully people because everybody's opinion should be heard. Lastly, for more details on how to conduct incredible meetings at your company and get groundbreaking ideas from these meetings, please refer to topic 2 of this vlog here, where I discuss how hedge funds generate investment ideas in meetings. Thank you. Now, let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a superb job of discussing how the corporate culture in a firm is defined. And the episode also did a great job of showing how to negotiate with prime brokerage firms in order to get better pricing from the prime brokers that you deal with. However, the one critique I have of this episode is it gave the impression that Axe Capital only has one prime broker, which is unlikely to occur, as larger hedge funds often have more than one prime broker. As a result, I'm going to give this episode a hold rating. Please subscribe, and I'll see you very soon at our next reaction video when we react to Season 2, Episode 9. Thank you.